I'm going to bring in the next guest, which is Kewsong Lee. He's co-CEO of the Carlyle Group. Q, it's good to see you.
How are you? How are you, Alex? Good to
Hi,
see
thanks
you.
for joining. Great.
Glad to be
So
here.
we're taking a look at the poll here. So as we settle out, it looks like the majority of respondents expect a W shape, 47% a W shape recovery. So Q, do you agree with that? And if that's the case, like, what does that mean to someone who has to put like billions of dollars worth into the market in some capacity?
Well, look, there's so much we don't know yet. I mean, there's a sharp bounce back because I do think the worst is over in terms of April being the low point. But a sharp bounce back does not by any stretch mean a V-shaped recovery. I mean, what we're seeing, we have such an enormous global platform. What we're seeing in China, for instance, and that's probably the best example of something that's close to a V-shaped recovery. Given consumer skittishness, given some of the factors involved in terms of changed behavior, et cetera, we're seeing the economy come back to about a 90% level organically. In the U.S., I think it's going to be a little bit more challenging. The restart is going in fits and starts. There's a lot we still don't know. There's tremendous issues in terms of how we contact trace and mitigate other occurrences of the virus potentially in the future, liability issues that have to be worked out, and of course, there's the possibility of a jobless recovery. So if I had to say it right now, I mean, I really don't know, but I certainly don't believe it's going to be V-shaped. I think the bottom of it looks like it's going to be V-shaped, which people will look hopeful to, but then I do think it's going to struggle moving on. And I don't suspect we get to pre-COVID levels for a couple years, just given the nature of the recovery that's going to be difficult.
So that's interesting. Does that mean that in China, if you're back to like 90%, you expect that to then go down a little bit before we get another recovery, or are they on like the last line of the W?
Right. It seems to have plateaued a bit, but I think the most important thing to appreciate, Alex, is that in China, if I were to ask you how much money was spent by the government to get that recovery going, it's virtually nothing. So they managed their recovery on a very organic basis. Whereas if you look at Europe and the United States, tremendous amount of fiscal stimulus and sustenance was required, injecting it into the economy. So they have a lot of ammunition to go. And you also have to understand the export portion of China's economy has remarkably shrunk over the past 10 years, something like 40% down to closer to 20%. And so given that, China's got a lot more going for it than you'd think, and there may even be a chance that it does not hit a recession this year. Unfortunately, I think the United States, we're going to have a little bit more fits and starts. I do think the resiliency of our economy is such that we'll power through this, but it's not going to be a classic V-shape. I would be more in the kind of check mark shape with some squiggly lines along the way, as the second part of that V is a little bit lesser dramatically sloped and more jagged.
You're adding squiggly lines now, because that's like another thing. It's like another checkpoint we have to make. So does that mean from an investment perspective that you'd rather be investing it's a better chance to put money in China than into distress in the US or in Europe, for example?
Well, I think, when you have a platform as large as we are all over the world, all asset classes, all these different investment strategies, the question is not, are you investing or not? Because we're always investing. We're active, but it's being selective and about understanding where you want to put your money to work, because there's a difference between investing aggressively and investing wisely. We're in the long-term business where we have balanced perspective, and that's what our investors pay us for. And we've been very selective about being aggressive in the credit asset class, particularly in the opportunistic strategies. We really like healthcare and tech, particularly in parts of the Far East. And so we have been deploying not as aggressively as as some may say, but it's been pretty darn active. But investing is not only just putting money to work, it's also trying to understand how to exit appropriately. And we have been pretty successful even during these times with pandemic with respect to IPOs, for instance, ZoomInfo or One Medical. both successful instances of IPOs during troubled times, but also M&A sales in Japan and in other parts of the world. So we have a, we're always selling, we're always buying, but it's about being selective and targeted and investing wisely with a long-term perspective, which is what we're trying to pursue.
So, and Manny and John kind of touched on this in their panel, is the decoupling kind of everywhere. And I say decoupling of the US and China, but it could also be the EU and China. It could be the US and the EU. How does someone like you, who's looking for opportunities across the board, look at that conversation?
Right. It's funny, Alex, and I'll bring this into it in my answer. If I were to ask you or the audience to close their eyes and go back to pre-COVID, and I know it seems so far away, but if you were to go
I
back
don't
into
remember that, Q. I can't do it. It's too hard.
I long for that. If you go back to the fall of last year and close your eyes, and you were speaking to Manny or me or others, the trends we'd be talking about would be low global growth, low rates, disinflation, no inflation, abundant energy, the impact of disruption of technology, polarization, nationalism, populism. You'd also be talking about trade tensions and decoupling. And if now all of a sudden you open up your eyes and you're in a kind of in the crisis moment, none of those trends have changed. None of them have changed. It's still low global growth, low yields for probably a lot longer than we'd imagine, disinflation, abundant energy. If you were watching CNN or Fox before the crisis, you're still watching CNN or Fox during the middle of this crisis. So that goes to the whole decoupling and the tensions that we're seeing between the U.S. and China. I think this is, clearly an issue for all of us with respect to, a major paradigm. The globalist framework is at risk and is changing. I do think this is something which is not going to be for the better. We're all better off if the two largest economies in the world, these two large ecosystems, can figure out how to constructively engage to the mutual benefit of both and the world. But clearly, there are issues right now with respect to that relationship that our leaders need to resolve moving forward.
Then in terms of, say, investments here in the US to capitalize off of that, where are the opportunities? I mean, if we're going to reshore some manufacturing or building, is it warehousing, is it inventory? Like, where are the good opportunities for you?
Well, in terms of sectors we like, obviously, it's simple to say healthcare and technology. If you're looking for growth longer term, you can't help but to think there aren't great opportunities in the Far East. But I like to talk about the 5 C's, the cloud, e-commerce, cyber, cashless, and collaboration. And those are all trends that are picking up. And irrespective of what industry you're in, if you can pick up on any of those trends, I think you've got an interesting business model. What we've noticed during this crisis is that many trends have accelerated. And businesses' ability to be disruptive has actually increased. And so a lot of the opportunities we're looking at right now tend to be more growth oriented. The traditional late stage, very large buyout private equity deal is something which I think is going to be a little bit more slow in coming as we all try to find our sea legs with respect to the future earnings and as it relates to kind of our assumptions as to where all this is going. But growth investments in some of the sectors I've identified and some of the themes that I've just talked about are all very interesting and compelling.
And this is for an audience member. This is actually a great question. I was going to try and go there. Was private equity marks in Q1 were very tough for most major firms. Has the crisis adjusted underwriting for new deals, and if so, how? And it's a good question too. Like who has more control? What do covenants look like? How have contracts changed, etc.?
Yeah, buyers mark to market faster than sellers, and so I think just transacting in terms of the traditional private equity deals are just going to get harder, which is why I think you're seeing volumes fall. With respect to investment return requirements, it all really depends. I mean, for very, very stable, safe companies, resilient companies, in many instances, we might be willing to pay even more for those types of companies now than we otherwise would have, because it's just been proven that they can get through a crisis like this, navigate through, and continue to grow. Those are very, very valuable companies. What I'm seeing happening is almost a bifurcation into the haves and the have-nots. It very well may be that certain types of companies and business models actually command higher multiples, where we're willing to pay higher prices, maybe accept lower rates of return for those companies versus the have-nots. Um, in a world, Alex, where rates could be zero for a long period of time, I think the real interesting question for investors to have to answer is going to be, well, what's the right risk premium and what are the right return expectations for various different asset classes? If you think that rates are going to be zero for a long period of time, you can't help but to think there's going to be some type of compression over the longer term with respect to returns. As it relates to Carlyle and what we're looking to do, um, it's all about the CEOs finding the right companies in the right sectors. And we feel that if we can do that well and partner with them over a long-term time frame to build their businesses, the returns will work out just fine.
Another audience question here, talking about China, we touched on it briefly, but if we kind of walk forward a US-China trade or non-trade deal, if we go the route of decoupling, if a trade deal doesn't work out, particularly as we get much more stress towards the election,
Right.
does that create more or less opportunity for you here or in China?
Um, Given our footprint, no matter what happens, I think there's going to be opportunity for Carlyle as it relates to change and the environment as disruption occurs. Obviously, investors are able to find opportunities when that happens. But taking a step back, I really hope that doesn't happen. I think it's really important for both sides to make phase one work. It's almost symbolic at this point that both countries have the will to enable phase one to happen. I do think the rhetoric needs to come down from both sides. In particular, and this was just touched on in the last interview, there's this notion that we need to 100% onshore. And I think the argument needs to be much more, the narrative needs to be much more about resilient supply chains. And resilient supply chains do incorporate an amount of onshoring, but for American corporations to be truly competitive in this global marketplace, we need global supply chains. If you talk to a lot of CEOs, that's exactly what they appreciate and understand. And so there's a lot of complications as it relates to the whole U.S.-China, the trade deal, and the potential impact of decoupling. But I just want to say, stepping back, I think it's really important that phase one, that part of the agreement gets fulfilled, and that we carefully think through the right narrative as it relates to the resilience of supply chains moving forward.
Yeah, so yes, but please don't let it get to that, is what you're saying. So the other thing is, if you talk to any private equity person or really any major investor in like 6 months ago, pre-COVID, all the talk was about ESG, and it was really primarily focused on the E and a lot of environmental investments and impact investing, et cetera. I feel that now the S has become in so many ways more important as we come out of this. I'm interested in what Carlyle is doing and thinking in terms of investing in ESG, but also how you rank the companies that you're already invested in to see if they're meeting the criteria that you want to stand by.
Sure. As far as Carlyle is concerned, the E, the S, and the G, they're all important. It's all about having maximum impact. And so for us, the whole notion of impact is it's not a product. We think about trying to have impact in every single company and every single investment we make by simply having a philosophy that our job is to make businesses better across the board, from revenues, from cost, from capital efficiency, but also in terms of diversity at their boards, in terms of what they're doing with respect to climate change and sustainability practices. So for instance, we have one company where we've put in place a capital structure, a bank financing structure, whereby if that company improves its ability to be more sustainable with respect to some of its manufacturing processes, the cost of financing actually comes down. So the banks have motivated us and motivated this company to continually improve on its sustainability practices. And if that happens, the cost of its debt actually falls. So there are lots of different ways that we are trying to push our way of thinking into our investing processes. But it's an integrated mindset. It's not a product. It's a mindset of just appreciating that our job is to have positive impact. Our job is to drive a total value creation, and the only way to do that is to adopt a mentality of let's make businesses better. And it's all aspects of ESG that's required to do that.
So, so in a rudimentary sense, if you were already invested in a company that had no minorities on their board, would you now go to them and say, you got to get one on your board in 3 months or else I'm dumping my investment, even if the company did have good free cash flow and was a solid company?
Sure, sure. So, Alex, this is a really important topic and something that we've actually been working on for many, many, many years. A handful of years ago, we implemented a policy that in all the companies we control, we wanted at least 2 directors with diverse backgrounds on their board. And, we made tremendous progress in the US. Close to 90% of our controlled companies now have at least 2 directors with diverse background. And we are now in the process of upping that even higher. And so this is not something we've just started or we're going to do in the future. We've already been doing this, but we have more work to do to continue to drive improvement in this area. And let me just address why this is so important for us. Diversity and diversity of background, diversity of experiences is exceptionally important in a business like ours because we are in the judgment business. We're in the decision-making business. And in today's complex world, you want as many different viewpoints, perspectives, and you want the benefit of those diverse experience and insights helping you make those judgments. And our experience is having diverse boards, having diverse leadership really enables us to make better decisions. And if we can do that, the superior judgment results in better investment results, which obviously inures to the benefit of our clients. So this is a really important topic for us, not because it's a statistic or it's the theme of the day. It's at the very essence and core of what we do, which is to make great investment decisions on behalf of our clients.
So how active would you be in that? Like, I get that you already screened all your investments past certain criteria. If you up the criteria, how active would you be in then divesting those businesses that didn't work for you on those metrics? Like, where we're really going to find change is through the pressure from the people with money.
Sure. So we no deal can get done at Carlyle without, from the very beginning, ESG screens, and that's part of our whole investment process. In fact, no deal can even come to the investment committee at Carlyle without a thorough check on all of these topics. So it's integrated from the very beginning of our investment process. And it's not, it's an entire team, an entire function we have globally at Carlyle. Furthermore, once the deal is made, we track and monitor how these companies are doing against these metrics, and then we report to them, to our limited partners. So, it sounds so theoretically elegant. It's exceptionally hard to do practically around the world. In Europe, I think we're more ahead than in other regions of the world, but we are certainly trying our best to figure out how we import and export our best practices across the firm. Because this is important. Like I said, this helps to drive our investment return and our ability to drive value. But it has to be from the very beginning all the way to the end. It can't be something that you just all of a sudden say, "Oh, okay, we got to check that box. Let me just go get that analysis done." That's just not the way we think about it at Carlyle.
Okay, sure. I'm at home, and maybe, are you at home or are you in the office?
I'm now at home. Yes, I am.
You're at home. So can you tell me what Carlyle's doing at bringing people back to work? I mean, I know we want everyone to be safe, but is there a world where like half your staff works from home all the time?
Right. So really quickly, we have 32 offices. We have our Far East offices are up and running. India is shut right now. Continental Europe is up and running. London, New York, and DC are still closed. We're targeting a September date for a reopen with those offices. This has been very challenging, but I'm really proud of how Carlyle has come together. We have adapted to this remote work environment incredibly well. Just so you know, Alix, I tracked this over 120,000 Zoom calls just in the past 3 months, and we haven't missed a beat. My view, however, is that you're all better off, everybody in the office. You're almost better off everybody not in the office. And the worst is if you have kind of a half and half hybrid where some people are in and some people are out. And so obviously we're focused intensely on the safety and the well-being of our employees. We're carefully thinking through what the ramifications are of how we get them to work. But I'd be remiss if I didn't say, Alix, that I think while video technology and video collaboration has enabled all of us to keep our businesses going, it's enabled us to sustain what we do. I do think this erodes company culture, and this erodes a company's ability to be effective over the longer term. So the leadership team at Carlyle is very focused on, as soon as it's safe, making sure we can get all of our employees back so that we can continue to work together and really develop the relationships internally that's required to keep our culture vibrant, so that we can continue to compete while moving forward.
1,200 Zoom calls or something? That's insane. That's not good for anyone's health.
100, as well as I do, it just wears on you, right? These calls just wear on you over time.
Totally. All right, Q, thanks a lot. It was really great to chat with you. I appreciate all the insight. Kewsong Lee joining us from the Carlyle Group.